What's up, everybody? Today, I want to talk about healthcare, specifically health insurance stocks in the United States. I'm not just talking about United Healthcare or Elevance or Oscar Molina or Centene, though we will dive into some of my favorites. The bottom line is this: the entire healthcare sector is dirt cheap. This is my pound the table moment for these stocks. I'm looking at these companies to significantly increase in the next 3 to 5 years, and I think my assumptions are pretty reasonable. If you're getting value from this video, please subscribe to the channel. We just passed 50 subscribers, so a huge thank you to everyone who's followed the investment diary. Now, let's dive into it. Firstly, why the sell-off or why I'm bullish? The sentiment around all these companies is awful. If you just look at the charts, UNH has fallen off a cliff and is actually down over the past 5 years. Centene has fallen even more, down 70% from its peak, with a 40% drop just in the beginning of July, when they removed their guidance and announced a tough year ahead. Elevance just reported earnings. They're at least up over 5 years, but they're still down about 50% from their peak and dropped even more after their earnings release. Pretty much all of these stocks are at lows. You get the point. There are problems and real risks in the health insurance space. However, I believe most of these concerns are temporary. Health insurance demand is only going to go up. The revenue for all these companies, Elevance, UNH, it's just going to keep climbing. Look at their revenue over the past 10 years. UNH, Elevance, Centene, Molina, it's all up and to the right. The reasons this will continue are simple. Asterisk, the US is aging. Our population isn't just getting bigger, it's getting older. An older population inevitably means more demand for healthcare and more revenue for these companies. We're not getting healthier. It's sad but true. Rates for chronic diseases like diabetes, obesity, and heart disease are going up. Regulation creates barriers to entry. Yes, there's a lot of regulation, which causes fear. But because it's so regulated, it's incredibly difficult for new players to get in and compete with massive companies like UNH. They have enormous scale. I think the next 10 years of these revenue charts will look a lot like the past. 10. These companies have historically grown even around 10% on the top line, and low teens on the bottom line. These are companies that have consistently grown their earnings by double digits. They are dirt cheap. And guess what? They're trading for right now. UNH has a forward price-to-earnings ratio of 13. Elevance is at 9 times forward PE. Free cash flow tells a similar story. UNH at 10 times free cash flow, and Centene at 9 times free cash flow. These companies are dirt cheap. Demand for healthcare is going to be incredibly strong going forward, with a very long runway into the future. And you have these market leaders, these dominant companies, trading for around 10 times earnings. This, folks, is what deep value looks like. I think there's going to be a ton of money made in this sector. How U.S. health insurance works. I hope I've got you interested, because now we need to talk about something a little more boring. How health insurance in the U.S. actually works. All these companies are health insurance companies, but they're quite different. This infographic breaks down how some of the big health insurance companies make their money. They essentially split revenue into 3 big buckets: Medicaid, Medicare, and commercial. Medicaid, this is mostly for low-income families and disabled people. It's largely controlled by the states, which negotiate rates with companies. The federal government reimburses the states, but each state controls benefits differently, and people frequently move in and out of eligibility, leading to high churn. It's also a very low-margin business, about 1% to 2% operating margins. It's all about scale, not pricing power. Medicare sounds similar to Medicaid, but is significantly different. Medicare is for older people, so it's a much more stable customer base. They're not bouncing in and out of eligibility. It's a federal program, Insurance companies have contracts with the government, getting paid based on a risk-adjusted score for how sick their population is, plus bonuses for quality of service via a star rating. Margins here are around 4% to 6%. Commercial, I'm going to divide this into 2 segments. Employer-sponsored plans. If your company offers a health plan, that's an employer-sponsored plan. Employers hate changing healthcare plans, so they rarely switch. This is the highest margin segment and the lowest risk. The average person working at a major corporation with an employer plan is generally healthier than someone on Medicare. For example, you're looking at high single-digit operating margins here, like 6% to 9%. Marketplace plans. This is when you hear someone got their health insurance on healthcare.gov or an AC. You shop for plans, and insurers price them very competitively. If you're a healthy person who doesn't qualify for a subsidy, you might find marketplace prices insanely high. That's because these companies have to set prices to provide service to sick people, those with chronic conditions, and anyone needing healthcare, regardless of pre-existing conditions. If healthy people decide not to pay for marketplace insurance, the pool of users becomes sicker, forcing prices to rise. This is called morbidity shift, a challenge several companies have discussed. You'll notice these companies target different segments. Asterisk Molina and for example, are primarily focused on Medicaid. Centene's 35% commercial segment is almost entirely marketplace. Meanwhile, Elevance, UNH, and CVS are heavily targeting the commercial segment, but specifically the employer-sponsored plans. You might be surprised to see CVS here, but they own Aetna, the third largest health insurance company in the U.S., and it's a huge part of CVS's business. This focus on higher-margin employer-sponsored plans is why UNH is not only the biggest healthcare company, but also has the best margins. It's not just scale, it's their health insurance strategy. They're not competing for the same customers as Molina. For instance, another company I want to mention, which isn't on this graph, is Oscar Health. Oscar is a favorite among retail investors, and is probably the only company in this sector I'd consider a growth story. They have almost no exposure to Medicaid or Medicare, and are nearly exclusively focused on marketplace customers. But truthfully, I pretty much like the entire sector. I like UNH, Elevance, Centene, and even CVS. I'm 100% serious when I say I think this whole sector is extremely undervalued. Again, I'm looking at potential triples on some of these in my base case. So, what's going on? 1. Increased medical care utilization. This is the big one. People are simply going to the doctor more and getting more elective surgeries than these companies anticipated. Part of this is likely a COVID effect. Insurers like UNH looked at past years, like 2021, and predicted current doctor visits based on that data. But in 2021, far fewer people were going to the doctor for elective procedures. They were staying home due to COVID. So, overall, medical costs for insurers were artificially low for a couple of years, causing them to set prices too low across everything from Medicare Advantage to marketplace plans. Remember, this is a business of razor-thin margins. If your costs rise by just 5%, it can wipe out an entire company's profit. 2. Tightening Medicare Advantage rates. Rate increases for Medicare Advantage plans in 2025 were lower than expected, meaning less revenue for companies where Medicare Advantage is a big part of their business. This impacts United Health, CVS, and UNH. 3. Medicaid cuts. While Trump didn't touch Medicare, new eligibility restrictions were added to Medicaid. This is definitely a concern, particularly for Centene and Molina. There's also general uncertainty about potential future cuts. 4. Pricing competition in the marketplace. This is probably lower down on the list, but there's a lot of pricing competition in healthcare generally. Now, you have companies like Oscar Health aggressively pricing in the marketplace. There's a risk this could create a race to the bottom where everyone tries to compete for market share by bidding for the lowest price, potentially driving margins to nothing. Here is my investment action. I don't want to downplay the risks too much. There are real concerns here, but when I look at the space, I think many of these concerns are temporary. Companies are going to Elevance, CVS, Centene, they're all basically saying they're focusing on margins over membership and are concerned about profitability, so they're going to reprice their plans. I think in a couple of years, we'll look back at this whole sector and say it was ridiculous for it to get this cheap just for a single bad year of earnings. As for what I'm doing, I already had a position in UNH, and I will continue to allocate funds into healthcare as the entire sector is extremely undervalued. If you're still watching this video, I'm guessing you're interested in the sector, and you won't want to miss those. I'll wait until after UNH releases their earnings this week to make my video on them. With that, I think I'll leave it here. If you got value from this video, please subscribe to the channel. If you agree or disagree with anything I said, let me know in the comments below. And if there's a health insurance company you specifically want me to dive into, let me know that down there too. I hope to see you in my next diary.